Good morning, traders. Have you ever wondered about the VIX and its level of volatility and how it moves? Let's get into it this morning. A couple of quick reminders, though, as we get started. Everything we talk about simply for illustrative and educational purposes only. If you're going to consider option strategies, recognize that they have significant risk. They're not suitable for all investors. Make sure you understand the characteristics and risks of option strategies before considering any option transaction. Now, let's jump out here into the Thinkorswim desktop software platform, and we're going to take a look here really quickly at the VIX, the Volatility Index, and it's a fairly widely used metric of volatility in the market, the expectation that the market has for movement. Oftentimes, it's considered to be a fear or panic gauge, and when the VIX is falling, that generally means that option prices on hedging products are getting cheaper. When it's rising, which often happens in a panic, it means that those option prices are getting more expensive. Now, we're not suggesting trading any of those options, just simply using this as a market metric. So, taking a look at the VIX right now, we've got a 30-period moving average on the VIX index. That's been moving down. The VIX is now falling into right around the 17 to 17.5 area, which is relatively low compared to where it has been. You can see that some of the spikes that we've seen on the VIX. As that VIX moves lower, that suggests that there's less panic, less concern about overall adverse market movement because institutional investors haven't necessarily been willing to pay to buy hedging products to offset that adverse movement. But this doesn't tell the entire story. We're going to switch to a different grid here, which shows us the VIX itself, that's the blue line, relative to the VVIX, the volatility of VIX. So the white line there, that VVIX line, is roughly the equivalent of the VIX of the VIX. How expensive is the VIX relative to where it has been? When we see that the VVIX, the white line, is below the VIX level, the blue line, that generally indicates that institutional investors not willing and really not active in buying those hedging products. However, that doesn't tell the entire story. I've got the purple line here, which is the S&P 500, which has been moving higher. So it makes sense that if the market's moving higher and volatility is bleeding off, there's less expectation or less worry of the market moving downward in an adverse movement. But at the same time, when this market continues to move higher, what you're starting to see is the possibility that institutional investors are maybe taking advantage of the old adage that maybe it's a good idea to buy umbrellas when it's not raining, buying protection when that protection is relatively cheap. Now, that's not at an extreme. I've got one more tool down here in the bottom of this panel, and that's the price ratio tool. So I've just simply created a price ratio between the VIX and the VVIX, and I've put it into some relative ranges. When the panic is over and the movement of the VVIX is significantly lower than the VIX, we'll see that price ratio down below the 4 level. And you can see that over the course of the last year, we've not been below that 4 level. There's really not been that complete, absolute easing of uncertainty, if you will. When this price ratio is above 6, that suggests that institutional investors are willing to buy volatility products to hedge risk at whatever price they're being offered. When that VVIX is well above the VIX, it's at an extreme. Institutional investors are piling in, that's the assumption, piling into those hedging products. Now, where the VVIX price ratio is currently sitting at about 5.4, sits below that extreme level of 6. It's kind of in that no man's land in between 4 and 6 in this particular case, which suggests that VIX, if it's falling, is neither really expensive nor really cheap, number one, And number two, where this price ratio sits suggests that institutional investors, while they may be starting to nibble at some of those hedging products, are not doing it at an extreme. So what that suggests is they really don't, as this price of the S&P 500 continues to climb, those institutional investors don't really have an expectation of adverse movement in the near term. Now, that does not mean that news couldn't change the circumstance and change the situation altogether. And that's why the VIX can and does often move in response to panic. And we can see that scenario going on here a couple of times where that VIX has spiked. But that suggests that we're in a position where the market, the S&P 500, could continue to climb this wall of worry for some time. Now, there is one other factor to consider here when looking at this relationship, and that is that if VVIX is starting to rise, but it's not getting to an extreme, and VIX is not dropping back to the levels that it was, say, for instance, back in December and January, that there might be some aggressive call buying going on the part of institutional investors to take advantage of this upward movement in the S&P 500. Now, that does not suggest that they have that continual expectation going forward, but in the very near term, this may be one of the mitigating factors that's keeping the VIX relatively elevated. That might be potentially a bullish indication. But once again, news can change that circumstance. So it's interesting to dig into some of the nuances that we see with the VIX and its relationship to volatility and its relationship to the market. Always one of those things that is an interesting aspect to trading around volatile market conditions.